Good morning, everyone, and welcome. Thank you for joining us today for our webinar on financial literacy for women with RSM. My name is Kendall and I'm from the R Network, and I'm also joined with Danielle, who's also from the R. So before we begin, I would like to acknowledge the traditional owners of the land on which we're meeting today. And for me, that is the Wadandi saltwater people of Wooditjup, and I pay my respects to their elders past and present. So RSM is one of our major partners, and together we're working on strengthening regional women's access to and understanding of all things economics. So I'm thrilled today that we're tackling financial literacy, and I'll introduce our presenters shortly. A quick note on housekeeping before we get started. You are welcome to submit questions throughout the session via the chat or the QA function. We'll address as many as possible at the end, and if we don't get to all of them, our presenters will pull together a follow-up resource to share with you all after the event. So it's my pleasure to introduce our presenters. We have Steff Wallner, joined RSM in 2015, and she is a manager in the Business Advisory Division, working closely with individuals and small businesses to simplify complex taxation and business challenges. We're also joined by Amanda Rocco, who has been with RSM for over 10 years and supports middle market and regional SMEs across Western Australia, helping clients meet compliance obligations and build financial clarity through a practical, small business focused approach. So I'll now hand over to Steff and Amanda to take us through today's session.
Thanks, Kendall, and welcome to everybody. Lovely that you could join us today. So we're accountants, we're not, movie stars, so bear with us, and we'll do our best so that you can leave the end of this session understanding why women face different financial risks, knowing the foundations of financial literacy, understanding what financial independence actually means, and we're going to leave you with 3 to 5 practical steps that you can act on immediately.
Can everyone see that?
Yes.
Awesome. Good. First hump over.
So why financial literacy matters for women? One of the biggest ones is the gender pay gap. In Australia, women earn approximately 79 cents to every dollar that a man makes. And so over a year, this adds up to approximately $28,350,000. I think I've said thousand twice. Now, women retire with about 25 to 40% less super. Women live longer, so we need money for longer. We have career breaks, caring for children, and just caring in general, and that directly affects our income and our super. And also the sad fact that financial abuse affects 1 in 6 Australian women. So basically, financial literacy, what is it? Well, it's not being good at maths for a start. So what it does mean is understanding your cash flow, knowing where your money goes and where it comes from, knowing how to protect yourself, which is very important, making informed decisions, even if you outsource advice. So it doesn't mean day trading, it doesn't mean being wealthy, and it doesn't mean knowing everything. So you don't need to know the stock market obsessively or anything like that. So you don't need to know everything. You just need to know enough to ask better questions. We're also going to discuss the core pillars of financial literacy. So as you can see, there's cash flow, the emergency buffer, debt, superannuation, and protection and planning. So we're just going to go through each one. So cash flow, income versus expenses. So you need to know what your income sources are, how much you're earning, and how much you're bringing in. So how much your household brings in, whether it be weekly, fortnightly, monthly, you need to be aware of how much that is. Your expenses, you need to know what your spending habits are. There's discretionary versus non-discretionary. So that's the things that you you can opt whether you spend them or not. Your new shoes, unless you're Joe Gilbert, of course, we know that she likes a new shoe. Sorry. So there's the things you can choose not to have, and there's also the non-discretionary, the things you need to spend so that you can run your household, so that you can look after and feed your children, and you can get through and keep that household going. Lifestyle inflation, it's also known as lifestyle creep. That happens when your spending quietly increases as your income increases. So you might get that pay rise, fantastic, $10,000 a year, but then all of a sudden you can get a better car, or you can get better shoes, or and therefore what you're actually earning extra is being spent as your lifestyle matches your income. And you're missing a really good opportunity here to build long-term financial security if that applies to you. So it needs to be something that you're aware of. An emergency buffer. So that is having money set aside to cover 3 to 6 months, ideally, of your essential living expenses. So your housing, food, utilities, transport, everything that you need to keep your household running and keep the people that you care for going for 3 to 6 months. Why 3 to 6 months? Because women statistically are more likely to experience career breaks for caregiving, part-time or casual work, and income volatility. Having a 3 to 6 month buffer smooths a cash flow when income dips or stops, so a temporary pause doesn't become a financial crisis. So the buffer essentially buys time to recover, regroup, or re-enter work. It also covers the unexpected events, motor blowing up in your car, your washing machine, TV, whatever it is. Having that buffer there allows something like that not to mean you can't feed your children. So you've got those funds there. It also reduces reliance of debt on other people. Having to ask for money, no one wants to do that. So being able to have that yourself is just peace of mind. It's especially critical for women with dependents or caring responsibilities, single income households, and those with flexible or casual work. And financial dependence is one of the biggest barriers to leaving abusive relationships, coercive control, or unsafe or discriminatory workplaces. So that emergency buffer means you don't have to stay because you can't afford to go. So for women, this is as much about safety as it is about savings. Debt, understanding your debt. So there's good versus bad debt. So not all debt is bad, but some is worse than others. So your good debt might be your productive debt, a home loan. If you're running a business, business debt under control. Most businesses will need an overdraft or something to get through. That's not what we consider a bad debt if the business is producing income. High risk debt, however, is your credit cards, your buy now, pay later, your personal loans with a higher interest, because interest will generally work against you unless it's managed carefully. Now, superannuation, this is a huge one for women. Because for most women, it's going to be one of the largest lifetime assets you ever have, apart from your home. It's also tied directly to your work patterns, because when you work as a wage earner, you're incurring, you get your super, your 12% super. So therefore, that's how it's tied directly to your work patterns. And it's important to understand the impacts on your super of your career breaks. So leaving the workforce to have children, no super is being contributed during that. Part-time employment as well. Once you return to the workforce, but you still have your caring responsibilities, less super is being accrued. Also, the lower than average wages, because super is paid as a percentage of a person's ordinary time earnings. So the higher your wage, the higher your super contribution. And conversely, the lower your wage, the lower your superannuation contribution. So, and with employer contributions, we recommend check your pay slips. At the moment, it's 12% of your earnings, which should be being paid by your employer into super. Not all employers are fabulous, so you do need to check that is being paid. As of the 1st of July, payday super is being implemented, so everybody's super needs to be paid the same time that their wages are paid. So rather than every quarter, now it's every time you're getting paid. So again, check your pay slips, make sure that's happening. Another thing with the super, you need to know what your fund balance is. If your super fund, most of them have apps now, we really recommend get hold of that app, stick it on your phone and make it close to the front, check it, have a look at it, know what's happening with your super. Every super fund, there's default insurance inside super. So that's automatically included with your super account when you join a fund for the higher income, for the higher balances. So check out whether it's opt-in or opt-out insurance that you've got in your fund. And while as we're not able to provide financial advice, so we're not telling you what to get and how to get it, just know what you've got and discuss what you may or may not need with a financial advisor or someone that you trust.
There's all different types of superannuation that might be covered in your super fund, whether it's life insurance or total and permanent disability, income protection. But you might have income protection insurance outside of super, but then you might also have it in your super fund, and you don't really need to be doubling up. So it's really important that you just check, know what you've got to avoid paying extra fees and just unnecessary costs.
Yeah. Thanks, Steff. Yeah. So yeah, so just and also be aware that insurance isn't free. So the cost for it, while it might be cheaper than insurance outside of super, it's definitely not free, and it will erode your balance. So check it out, see how much you're paying, and then you can make that decision for yourself. There's also the option of consolidating multiple accounts.
Yeah, so you can log into your MyGov account and actually see what super funds you're a member of. I did it a few years ago and saw that I was a member of 3. You're paying 3 lots of fees then, so it's not necessary. So we recommend consolidating your super into one fund. You can do it through your MyGov account. It's quite simple to do, and that way you just minimize fees and get it all in the one place, and hopefully the asset grows quicker that way.
Yeah, and with that, yeah, just check, because some people might have more than one fund for a reason. So all of these suggestions are obviously going on advice of a financial advisor as well. So we won't be giving any financial advice today. So also with super, you've got beneficiaries and binding nominations, which are critical because super is not automatically distributed under a will.
Yeah, that's right. So super funds decide who receives the money unless you make a valid binding nomination. So this means that an ex-partner could receive the funds, or a new partner could be excluded, or children could be excluded. It's up to the discretion of the super fund. So making what's called a binding death nomination is really important. That gives you the power to say where you want your money to go and in what percentages. It's basically a legal instruction to your super fund that says who you want the super to be paid to. And if valid, the fund must follow it. So it's really important. And it's also important to keep that updated. So if you have a relationship breakdown, old mate might still be on your death nomination. You don't want him to get your super, obviously. So make sure you update it every time there's a life event, or if you have a child, just keep it updated, as you should do with your will as well.
Yeah. So get the app, get it on your phone, and have a look through, and you can get some really good advice from those apps from the super funds, bearing in mind that they will promote themselves a lot of the time, so you may need advice to go with that. Okay, so also one of the pillars, protection. So planning for the unexpected. So your core protections, we've just discussed some insurance. So inside and outside of super, you can be insured for everything. So think about the big things in your life that if you were to, something was to happen, look at insurance to protect you in those circumstances. A will, this is critical. You may think you've got nothing, but without a will, it really makes it really hard for those left behind particularly, and if anybody has ever had to been a executor or administer a will, you'll know that without it, things are a nightmare. With it, it's tough, but without it, it's even worse. And you don't want the public trustee getting involved and all that. So if you don't have a will, it doesn't matter if you think you don't have anything, you still need a will, so that that gives you control of everything. Even when you're not around anymore, you've got some control over what happens to anything that you did have, including your children. So so powers of attorney are also really important. So that lets you choose someone that you trust to make decisions if you lose capacity, both temporarily or permanently. We never know what's around the corner, and that allows you to have someone to make decisions for you that you trust. Another thing to be very aware of is what you're signing. Many people might be a director of a company that someone in the family is running, or husbands, or this isn't husband bashing, by the way, or partner bashing, but this is often where you find that these things happen. But yeah, so if you're signing documents, ask what you're signing, and just then follow that up. Okay, I might be a director, sure. What does that mean? And what are you liable for if you're a director? And just because someone you trust has asked you to sign something and their intention may not be anything sinister at all, you still need to know that, because that's one of the things that can crop up down the track and really cause a world of pain. Particularly, like a director, what you're responsible for as a director is actually quite huge. So you need to be aware of things you're signing. How to do that? Look in your tax return. Is there income you're not really sure where it's come from, or is there an entity that you're not sure what it is? Ask about that and how you fit into that particular entity, so that you know what you're actually signing and what you're liable for. So what actually is financial independence? So what it is having enough money and systems so that your life is not dependent on one person, one job, or one relationship. So it gives you choice, safety, and negotiating power. So it doesn't mean that you're never going to work again. It doesn't mean being rich, and it doesn't mean living frugally forever. But what it does mean is choice, safety, and the very important, negotiating power. Now, there's different levels of financial independence, as you can see on the slide here.
I couldn't get them to go different levels, so I just had to put that arrow in.
We're accountants, we're not. So the basic level of financial independence, which everybody needs to endeavour to reach, is survival independence. So that's where this buffer is really important. You can pay your own bills, and you're not relying on anybody in the short term. Today, it's just so critical. You just need to look at the people living in cars with jobs, with because for whatever reason, for relationship breakdowns, you don't want that to be you. So, having some sort of backup is so important, and it's never been more important than it is today. The next level is stability. So that's with your emergency fund, so you can manage all the unexpected expenses. We've spoken about a few, and I'm sure you can all think of various unexpected emergencies that have cropped up where you think you're going all right, and all of a sudden you're up for a few $1,000s. It's very important. Lifestyle independence. So that's where it provides flexibility around your work and lifestyle choices. So you can leave a job, you can leave a bad relationship, you can restructure your work. It gives you income beyond your wages, potentially with investments or a little business on the side. So that's the next level of financial independence. And then finally, which would be fabulous for us all to be at, is the legacy independence. So that gives us long-term independence, choices about retirement, helping your children get set up, and control over your later life, as with retiring particularly. And this is all tied to not necessarily a cash, what you've got cash in the bank, but what you've got all the protections in place for yourself. So there's some common barriers for women. So we're going to, just normalise them because they are out there, and it's very real to so many people.
And I'm sure we can all relate to them, us too.
Yep. Except for not good with money. So not good with money. You don't have to accept you're not good with money, therefore you're destined to spend the rest of your life with nothing. That's a mindset. So that's something that if that applies to you, think about it and change it if you can. Fear of making mistakes, getting it wrong. You might be scared to invest in something, or scared to take that new job or whatever to get it wrong. So that often will prevent women from becoming financially independent. Delegating finances to a partner, so easy, would be lovely. And many people have that one person in their relationship that controls all the financing, and that makes it's a barrier, because even though it's nice in the short term, in a crisis, it's not so nice. So that can be a big barrier for women. And we'll talk about a few examples on that later. Shame about starting late. I'm already such and such age and I haven't got anything. Oh, what's the point now? It's never too late to start. Over prioritising others. So this is a big one for women, particularly with children. Focusing on setting your children up. So before we're even set up ourselves, we're looking at getting our kids into homes or getting them set up some way. So, and that's a big barrier to women with their financial independence, because we're thinking about others, spending all that time helping our partner build their business. You're important too. So be aware that does happen, and it also can be one of the reasons why financial independence doesn't come. So now we're just going to have a look at some practical steps we can do. So try to do them this year, if you can. The sooner the better. So look at your bank accounts and your debt. You need to know where your money is held, and that's all the money in the household. But you also need to have access to some independent savings. So that's really important too. And if you're in a relationship which is relatively equal, there would be no reason why each partner couldn't say, in the event of something terrible happening, I care about you, I want you to be set up. So it's not necessarily just for women, it's for everybody in a relationship. If you're caring about someone, you want them to have that ability to go on if something happens to you or your partner. Superannuation, that's the big one we spoke about, because it's such a big thing. And if you're working, you're getting super. So get that out. Know what is in your balance. The MyGov balance is only often updated at the end of each financial year, whereas the app will give you a daily balance. You can watch it up and go as petrol prices change at the moment.
And also review who the beneficiaries are, and check that you are getting those contributions. And if you're not, have a chat to your employer. And if not, have a chat to the ATO.
Yes, definitely. And so you'll see every time a contribution is made, if you've got the app, it'll show it on there almost in real time. So they're really, really, really worth getting and having a look at. So that's one of the things that we'd really, really like anybody that hasn't done that to do. The next thing is to plan your emergency buffer fund. Setting up automatic savings is a great way. So your personal financial knowledge, that's where that comes into its own. So you know what you need, and then you can save and start some sort of an automatic contribution to build up that cash buffer, because any windfall, stick it in there. And I don't know if with saving, we often refer to the barefoot investor, who's got some fairly good ideas actually, and he talks about saving first. So you save first, then if there's anything left, then you can go and spend that. But don't save what's left. Try and dedicate the saving to be the first thing you do rather than the last thing you do with your income. So you need to, so knowing that personal financial knowledge of what comes in and out is really important to working out what you can save. Prepare a rough budget as well, so and even if you set yourself a target, how long will it take you to reach that target, break that down into pay periods and see if that's a bit more manageable rather than looking, oh, I'm never going to save 10 grand, I'm not going to bother. So, you know, bit by bit, edging and working out how is a good way for you to build that emergency buffer. Another thing we recommend is learning one concept a month. So a financial concept. So that could be something like how an offset account works. Speak to somebody at your bank. Fixed interest versus variable interest. How does it work? What impact will it have? How can you change it? And a lot of these things, like the bank people are very happy to chat to you about how this will work for you. An offset account also can be a really helpful account. Speak to the bank about how that can work for you. Negative gearing, always in the news. What is it? Find out what it is. Google will help you with so much of this. And even if you put in ATO next to it, you know, or Australian, you know, you're getting the right information for Australia as well. CGT is another thing. If you've got assets and you need to sell them, work out, you know, when is a good time to sell it. Speak to your accountant about that. They will definitely be able to help you on how that's calculated and what options are available to you if you have CGT. But find out what it is and how it could apply to you.
Yeah, so if you own shares or you have a rental property, just something you always have to think then, oh, capital gains tax, I've heard of that. Just do a bit of research, find out what it is, how it's calculated. You might not be looking at selling your investment yet, but you know, that could be somewhere 5-10 years down the track. So you're already a bit clued into what actually it is, so that when you come up for it, you know what you're going to face.
And timing can be everything with that as well. So it's just think ahead about that sort of thing. And use podcasts, books, your trusted advisors. I just mentioned The Barefoot Investor, which is a really simple family sort of friendly book as well. He's pretty good with some of his things, he says. And a document. So all your key information. Again, once you've been through administering someone's estate, you realise that this is so important. Passwords, your emergency plan, where is the money kept? It's really important that you've documented that somewhere and someone you trust knows where it is, because there's nothing worse than you know, it just everything shuts down and you don't have access to anything. So that's very important. But obviously security is the key as well. So we need to keep that in someone that you trust, that they have access to that. So yes, so we've so these are our so it's already finished. So so these are our the key takeaways that we're hoping that you would have from this. Did you want to
maybe we were thinking of a real life example. We've actually had a lady that we both know. She's early 50s. Early 50s. She was married for 30 years, and then recently her husband came to her and said, I don't want to be with you anymore. I've got a new partner. Time to separate. And obviously she was, you know, very flabbergasted by it. It was out of the blue. But for the 30 years that they were married, she's only told us this recently, but she left him to do all the finances. She didn't have any involvement. And she was always under the impression that there was her money and his money, and there was no joint money. So he was earning a lot more, obviously. So he had more money in his pot. And she's working part-time. She has 4 children. She raised them all. So her pot was significantly left, and he'd enshrined in her brain that there was her money and his money, and they didn't share money at all. And I think you pointed out to her that that's actually financial abuse. And her hearing that after 30 years of marriage was quite a shock to her. And so now they're going through the separation. They've got a lot of assets between them, but they also have a self-managed super fund and a trust. And again, she's been signing documents each year, not really clued up to what she's signing or what the trust does or what the self-managed super fund has. And now she's gone to a lawyer, and the lawyer's asking her all these questions, and she's just come back, you know, I have no idea. And her husband is not being cooperative with telling her or giving her paperwork or anything. And it's turning into a real mess. Yeah, and I think it was quite a shock for her to realise that she was actually being financially abused all these years. And I think that's a really common situation, unfortunately. So we told her to come to this, but she's busy. But yeah, so it does happen really, really. I'm sure everyone has a friend or themselves or, you know, knows someone that this is affected. And it's not always the partner. It could be a job or a coercive workplace or something like that. But yeah, it's very, very important.
Yes, and it's been quite devastating watching her go
Yeah,
through it as
yeah,
well. So
yeah.
so it's sort of a timely reminder to us while we're presenting this on how it really happens and it really hurts people.
Yeah.
So it's a life skill. If you can teach your children, even better. So it's something that's really important and should be taught in schools, we believe. But if not, if it can come from the home, that's great. But independence is about safety and choice, but both are vital, particularly if you've got carers. But even if you the other side of that and you're on your own, it becomes just as important again. Awareness, that matters far more than perfection. So just be aware and give yourself something to aim towards. And you might not ever have millions of dollars and sitting around, but just being aware of that and making effort to include that in your life. And your future self is watching. So that's also something to think about in 20 years from now, or even looking back in 20 years ago, what difference you could have made over that 20 years. Time goes so quickly. So it's something to always keep in the forefront.
Absolutely. I think that's the end. Oh, Q&A time. If we have any questions that have come through.
Denise, were you going to manage the questions or did you want me to?
Sorry, double mute. Hi, everyone. Yes, definitely I can. I'll just jump into them. Here we go. So thanks, ladies. That was, very insightful. So we can't actually see the name. It's just come up with your a number on here, but one of the ladies on the call has asked, are you going to talk about owning a small business and superannuation?
Yeah, we can. Yep.
Yeah.
So obviously, if you own a business, unless you're paying yourself a wage from the business, you're probably not having any superannuation put in for you on a regular basis. So it's an option before the end of the financial year that you can put in money yourself into your super fund, and you can then claim it as a tax deduction, which again is something worthwhile chatting to your accountant about to see how much tax you might save on that. Was there anything a bit more specific about that? Whoever asked that question? It can be really worthwhile if you run a business. It can be a really worthwhile exercise putting some money in and saving some tax that way. It's good to do some calculations before you do it just to see, obviously if you put money in, that's less cash flow for you, how much tax you can save by doing that. So we would definitely suggest it's an option for you, but just do some workings beforehand to work out how much it will save you. But it's really good for planning for the future, obviously, continuing to build your super balance each year.
Yeah, and again, that's something that you can discuss with your accountant who can tell you the tax effects of that. But it's also a really good thing to speak to your financial advisor about, because they can guide you in exactly how you should be saving for super and how to go about doing that.
So there are limits each year on how much you can put in. It's called a cap, but there's also it's a bit more complex, but there's rules that you can carry forward previous year's unused caps. So again, it's just it's all in your MyGov as well, but it's probably quite foreign unless you're sitting with an accountant that can just go through it with you and explain it to you and say, okay, well, this year you can put X amount of money into your super fund and claim it as a tax deduction. But it's probably only worthwhile maybe claiming X portion of it as a tax deduction. It's a good avenue, but it's worth having a chat to your accountant about to work out how best it can work for you.
Okay.
Does that answer the question?
Yeah.
Did you have anything more specific about that, or?
No, I was just asking, because I know you were talking a lot about previously about superannuation. You were talking about if you're in a working situation and getting superannuation from your employer, but you hadn't touched on owning a small business. So I wanted to know if I was just putting it in weekly, but I've got the capped amounts. I think they're at around 25,000. That's my understanding. So yes, I'll look into that a bit more, but I'm seeing a financial advisor.
Awesome. Yeah. So the
Yeah.
cap for the current financial year is 30,000.
30,
And
yeah.
you might be able to access some carry forward caps from previous years if you didn't use your cap up last year in the last 5 years. But your financial advisor, you said you're seeing, they'll be able to check all that information for you and tell you how much you can put in. But that's great that you're putting money in each week for your super. That's awesome.
Absolutely. Yes.
Yeah, I've just started doing it, and also the financial advisor said I need to review my super fund because there a lot of people are losing a lot of money on them at the moment because they have changed where they're being invested. So I have to review that as well.
Yeah.
Yes. Yes. And that's something that you need. A financial advisor, an accountant can't advise where to invest your money, but your financial advisor can. And some of the super funds offer chats as well, depending on where you are along the way, that you can speak to them. Somebody that's not going to cost you an arm and a leg, but it's definitely worth, certainly when you're self-employed, because you're having to put that super in yourself out of money that you've earned. So it's not just relying on somebody else to put it in for you.
That's awesome to hear that you're doing it each week. That's great.
No, I've just only started doing it, so I'll try and keep that up. That can be my emergency buffer.
Yes.
Well, not really, but a start. Yeah.
That's great. No, that's good to hear.
Yeah.
Thank you. And then next we had a comment from Enrica. I'll read it out because it's very relevant, talking about when you might have signed some paperwork that you didn't understand what you were signing. So she wrote, when I first became a director, when first married, and many years ago, I had no idea on the responsibilities. There was no education around it. So thanks for that comment, Enrica. And then Helen's written.
That's so true. Sorry, just to follow up to that. Enrica, how did you get the education around it? Did you just ask the questions, or?
I think she might have jumped off the call actually, because I can't see her.
I'm here.
You are? Sorry.
Yeah, no problem. Can you hear me? Okay.
Yeah.
Yes.
Yep. I suppose we had set up some companies with our accountant, and it was just, you became a director. I just think it's funny now, knowing what I know now, that there was, just become a director. It's a company, just sign these forms. And yeah, I didn't understand. I think now, obviously, you have to have director IDs now. So even the government weren't really, to be honest, too fussed about it. Anyone could become a director and you could set up a company. Whereas now I feel the responsibility and what it means is more, I think the information is more accessible now. So I suppose from asking questions of our accountant, from my own education, that's kind of, and I work with small businesses. So I suppose I'm just, through my own career as well, I've become more aware. But yeah, it is something now that I think when I hear a small business, like I always suggest they go talk to their accountant when they're looking at what structure, and to make sure that they understand the director responsibilities, because it does mean something when you become a director.
Absolutely. Yeah.
And the amount that you can get fined now with direct penalty notices and things, it's crazy.
Yes.
You really need to be informed about what you're signing and what you're part of.
Yeah.
That's good. Thank you.
Yeah. And part of the whole governance thing is ensuring that your directors have completed courses so that they understand it as well. And that doesn't always happen, but it's also something worth looking at.
Awesome. On to the next question. We've got Helen asking, can you explain super non-concessional and for low income earners and concessional?
That's a bit more complex. That's going to take a bit of time. Are you happy if we maybe send you a follow-up email just so we can get all the terminology and things right for that one? It's just that's quite a complex explanation. Yep.
She's just typing back now. And Kendall, you've got your hand raised.
Yeah, thank you. I just two things I was going to say. Just back on the superannuation small business, the Triple R Network recently did research and just did our annual report, just went out, and we did find, in our research that I think it was just 11% of Triple R women surveyed that were aged between 50 to 70 had balances between 26,000 and 55,000. And I think a portion of them were also small business. And when we spoke to women about that, they said it was really, really hard when you're starting up a small business or in a small business and on that, almost minimum wage, after you're paying everything, there's not much left at the end to put into super. So I just was making that comment and how that's a really tough space for many women to navigate. Just a question, if someone is not sure if their employer is paying their super, how can they check exactly?
Yeah, so the easiest thing would be download the app for your super fund, log in, you'll need your member number and probably set up a password, and then you can see all the recent transactions. So you can see if your employer is putting the super in. At the moment, it's required to be put in each quarter. As Amanda mentioned previously, though, from 1st of July, something called payday super is being introduced, whereby your super will have to get paid with every pay run. So when you get paid your wages, your super has to get paid at the same time. But the easiest thing, just check the super fund on the app, check the transaction listing and see if there's money going in. And if it's not, have a chat to your employer and just ask why. It should also show on your pay slip, but just because it shows on your pay slip doesn't mean they've actually sent it to your super fund. So I would check both, but definitely check the app.
And just on, it might be that your employer pays it, but is there a particular time frame that the super funds sit on processing that payment? So it's payday is super, but does that also happen? Is it like pops into the account immediately, or does it take a bit of time?
It takes time. Yeah. So we usually say for our business owners here, if your super is due on the 28th of July for the April to June quarter, you need to be paying it by about the 20th or the 21st, because it can take up to a week for the super fund to process it. And it technically needs to have been processed by the 28th. So it can take some time.
Okay.
So if you're running a business, that's also something to be mindful of. You need to be paying the super well in advance of the due date.
Great. All right. Well, I've just noticed that we've hit 10:47, so we're just a couple of minutes over. Before we start to close out, did anyone have any more final questions?
Yeah, I do, please.
Thank you. Yep. Helen?
Yeah, sorry, I can't get my camera to work, but my question was, I was asking about the non-concessional and the concessional, not that I know very much about it, but the lady who said she's paying in weekly, how do you ensure that if you're a low income earner, that you have access, if you don't know until kind of just before tax time where you're tracking, that if you put it in all regularly every week, which sounds fantastic, but you may then, how does it go if you've earned a little bit more than the minimum amount, that then you don't get the co-contribution from the government? Or I only have a very scanty knowledge. I'm just wondering if there's a way to kind of track it so that I would know when I am eligible for the co-payment from the government, or however it goes, because I work for myself.
I'm not sure if someone else could answer that. I'm just throwing it in there just to try and get my super up before I retire. I'm sort of in that time frame where I'm sort of 7 years out. I actually might be earlier than that, 7 years from getting the pension, but I think it might be earlier than that. But I don't know if someone else could answer that. I've just been advised by my accountant to do that.
To put it in weekly, is that what you're saying?
Yeah.
Yeah. Oh no, Joe. Gilbert.
I wasn't going to say anything today, but I thought I'd help you out because you both.
Thanks.
Yeah, so
Thank you.
I work with Amanda and with Steff, so I'm Jo Gilbert here in Albany. Just in answer to that question, I think what I'm hearing is at the end of the financial year, when you're lodging your tax return, you can also make a declaration to your super fund to say, of the contributions I've made for the year, this is how much I'm going to be claiming as a tax deduction. And if you've made a lot of contributions and you've actually advised the super fund that you're going to be claiming them all, most super funds will allow you to reduce the amount that you've previously advised that you're claiming as a concessional deductible contribution. They will more than likely not let you increase the amount that you've previously advised. If you go over the 30,000, then the balance can go into non-concessional, providing you've met the conditions for that. But most of those declarations or decisions can be made at the end of the financial year once you've got some certainty around your income and when you're doing your tax return.
Thank you.
Thanks, Jo.
Jo, how do I get in contact with you? I'm in Albany as well.
Oh, okay.
Perfect.
I can pass the detail. If Denise might pass the details on later.
Absolutely, can do.
Thank you. All right.
Thanks, Jo.
Okay. Any more questions before we wind up?
No, thank you. It's been very educational.
Great. Thank you so much. So thank you, Steff and Amanda, and thank you for joining us today, all of you. We hope this session has helped to build confidence and awareness around financial literacy and reinforce that financial independence is about choice and safety, not perfection. If we didn't get to your question, a follow-up resource will be shared after the event. So thanks again for your time, and we hope you enjoy the rest of your day. Thanks, everyone.
Thank you.
Thank you, everyone.
See ya.
Thank you.
Thank you.
Thank you.